Hello, my name is Elliott. I'm editor of Personal Finance as well as the Energy Strategist and MLP Profits. I want to talk a little bit specifically about what's going on in global energy markets. What we're seeing is obviously more of a macro or big picture type of driver for oil as well as energy related stocks. Really what's going on, it's all symptomatic of the European credit crunch. In Europe we saw the credit crunch really start in Greece. It started to spread to some of the other smaller peripheral economies in Europe, Spain, Portugal, to some extent into Italy. Then the EU came out and passed this $1 trillion bailout package. Kind of drew a line under the selling there. We've seen bond yields in places like Greece, Spain, Portugal back off. We've also seen credit default swaps, basically a way of betting on the potential for a country to default, also decline a little bit in these European peripheral nations. But there's still a fear that what's going on in Europe could infect the global economy in a way that it did back in 2008 when we were really more concerned about the U.S. subprime market. In this case, there's a fear that the European sovereign debt market could infect the global credit markets to the same extent that it did in 2008. In my view, looks highly unlikely. The key metrics to watch there, the TED spread. The TED spread is the difference between LIBOR, the London Interbank Offered Rate, which is the rate that banks charge to lend money to one another, and the Treasury rate, basically the rate on U.S. government bonds. When this measure spikes, in other words, when the rate that banks charge to lend to each other spikes relative to broader interest rates, that suggests that banks are reluctant to lend to one another, and that what you're seeing is a systematic credit crunch. Just to kind of put the current number into context, right now the TED spread trading around 30 to 35 basis points. That's 0.3 to 0.35%. Back at the height of the credit crunch after the Lehman collapse, it was about 500 basis points. So that's 5%. So right now, despite all the talk of contagion, we're just not seeing it. Several companies in my coverage universe in the Energy Strategist and in PF have come out with big bond issues. EOG Resources, symbol EOG, a big U.S. producer, increasingly focused on crude oil out of places like the Bakken Shale, as well as some of the newer plays like the Niobrara play in the Rocky Mountains. This company came out with two $500 million bond issues. The yield on these bonds, this is a single A credit, the yield on these bonds, no change from what you would have expected earlier this year. The company had no trouble issuing those bonds. In fact, the bond deal was pretty much oversubscribed. Just a little over a month ago, Lin Energy, a smaller MLP type company, symbol LINE. This company basically focuses on oil and natural gas production in the U.S., pretty evenly balanced between the two. The one thing they do have is a lot of hedges covering near-term production, but they're a single B credit, so they're well into the high yield or junk bond category. They wanted to come out with a $500 million bond offering. Demand was so strong, they ended up coming out with a $1.3 billion bond offering. Yield on that obviously a little bit higher, more like 9–10%. But again, that bond came out priced under 100. It's now trading over 100 despite the ongoing credit contagion. So what we're really seeing is that there's fear that there would be a global credit crunch akin to 2008. So far, not playing out that way at all. I'm looking at oil prices right now have come down hard from their highs around 87.50. They've broken 70. This is about equivalent to some of the corrections we saw in oil prices back in the 2002 through 2008 big bull market run-up in oil prices. So I don't think it's anything necessarily to be too worried about right now. I see it as rather temporary. Longer term, there are a lot of good signs out there. If you look at oil demand in the U.S., year over year, it's up across the board. Whether you care to look at gasoline, diesel fuel, distillates, jet fuel, up across the board. Europe is really not that big of an oil market relatively speaking, but certainly the core economies in Europe, Germany and France, even in England, showing some signs of a real recovery from the recession of 2008, early 2009. So I don't think we're going to see a big slump in developed world oil demand, and we actually might see some upside in the U.S. In China taking steps to slow down the pace of their economy. But again, the Chinese economy grew at almost 12% in the first quarter, and it's only expected to slow down to about 9%. Shouldn't have a huge impact on their oil demand. And then moving on a little bit to the supply side for oil, I think what we're seeing there is actually also a lot of tightening. As demand is recovering across the developed and the developing world, what we're seeing on the oil front, on the supply side, look at what's going on in the Gulf right now. There's a major spill. They've basically stopped issuing permits for new drilling in the Gulf for now. I don't think that's going to be a permanent measure, but it might delay some drilling, some production in the Gulf. It's also a very clear sign that it is becoming harder and harder and more technically difficult to produce oil, especially in your developed countries. You know, why in the world would BP be drilling in 5,000 feet of water and risking a spill like this if they could go onshore somewhere and produce large amounts of oil? Obvious answer is they can't. The only major suppositories of oil left in the world, giant fields, are located in places like deep water and Arctic, tough, technically difficult to produce fields. On the other side of the equation, I think there's a very real chance that with demand recovering worldwide, by the end of this year, you might actually have to see OPEC actually increasing their production quotas. They might need to supply more oil to meet global demand. Right now, they're effectively doing that anyway because a lot of the peripheral OPEC nations are cheating. They're producing more than their oil production quota. Typically, you would kind of think that would mean lower oil prices because you'd see more supply. But traditionally, that's not the way it's interpreted at all. When OPEC increases production, they decrease their spare capacity, that sort of cushion of oil production that they have offline that they could bring online quickly. Therefore, I think that could really push oil prices higher. I'm not backing off my target at all that sometime by the end of this year, we will see $100 oil. I think next year, there's a very, very good chance that we will see oil challenge those 2008 highs in the context of a total recovery in global demand for oil, as well as continued factors limiting supply. So right now we're seeing energy stocks factoring in what's going on in Europe, the credit contagion. That's what's driving this market. That's what's driving these stocks lower. Broadly speaking, over the next couple of months, I see this as a major buying opportunity. Focus on the oil services names, the oil equipment names. These are the companies that own the technology needed to produce those deep water fields. Perfect examples would be a company like Seadrill, a company that owns very new drilling rigs capable of drilling in the deep water. Also offers a yield of about 9.5% at the current price. Also look at a company like Cameron International, symbol CAM. This company makes subsea equipment needed to produce deep water fields. I think these are the kind of companies you're going to see a real return to growth as oil prices stabilize and move higher again. And I don't think that this temporary dip in oil related to European credit contagion concerns is anything to be concerned about for more than the next month or so. Thank you very much.